get to our special guest. St. Louis Fed Reserve Bank President Jim Bullard is our guest host for the hour. All right. It's great to have you here. So the Journal, the lead, Fed gives bullish signals on the economy. A, is that the correct interpretation? Were you more bullish? B, are you more convinced as a group that the 2% inflation target is coming sooner? And 3, all this didn't cause you to change the path, though, that you're expected in interest rate hikes. Has the Journal got all 3 of those things right?
You know, 2017 was a good year. The U.S. economy surprised to the upside. Global economy surprised to the upside, even more than the U.S. That drove earnings. That drove a good year for U.S. equities. So it was natural for us to be meeting in January and saying good things about 2017. So I think that part is accurate. We've got core PC inflation at 1.5%. Market-based core is at 1.2% year over year. So, you know, we've got a ways to go on this inflation story. Inflation's been below target for a long time here. I don't think we have to be in any hurry. I also think the market's kind of doing our work for us with the 10-year moving up, so I don't think we have to chase the 10-year up.
Yeah, except that the 10-year moves on every time that one of you guys, like if your left eyebrow raises that's true. So in January, the scuttlebutt is that you got even a little more bullish than the December growth projections, which were already elevated. I guess one of the questions I would have is, I have a problem with most mainstream economists and how long it takes them to raise their growth projections. Most of them are still at 2%, 2.5%, something like that. So you got all this stimulus, you got, what I think are growth policies that have been enacted and deregulation. Yep. So the Fed, it seems like you guys still look in the rearview mirror. Isn't that what you're supposed to do to anticipate growth? How come it takes you so long to raise growth projections?
I think good things have happened. I like the deregulatory agenda. I think the tax plan has some chance of working and firing up investment.
Dragging you guys kicking and screaming into raising growth projections.
In the forecasting world, things happen slowly. You're better off, inching up your forecast. So I think that's all that's going on there. But I think people are optimistic and hopeful that we'll have another good year in 2018.
Stock market seemed to get it before you guys.
I'll say this, though, the idea that we have to go 100 basis points in 2018, that seems like a lot to me. That's kind of price for perfection. Everything would have to go just right. The economy would have to surprise on the upside a bunch of times during the year. I'm not sure if that's a good way to think about 2018.
But I've noticed, I remember when you kind of switched. You found religion at some point. You wanted to raise rates for a while, or you seemed more hawkish, and then suddenly, it was about a year and a half ago or something, you got very dovish based on what? Based on inflation?
We used a forecast that was...
Jim Bullard.
Yes, I used a forecast that was very traditional, that had, that inflation was going to move above target, that we had to get out in front of it. And that forecast turned out to be wrong for 3 or 4 years in a row, so I decided to switch gears. And we're just in a low-rate environment globally. And one thing I'm concerned about is if a bunch of hikes this year, Fed policy will turn restrictive. You're not used to thinking of it that way, but that's where we are. The so-called R-star, the neutral Fed funds rate, is pretty low. So if we go up 100 basis points in this environment, you're going to be restrictive in an environment where inflation is still below target.
Although,
why are you doing that?
If you're looking
you don't
around
have
the globe,
to go that high just to get to neutral in this environment.
If you're looking around the globe, though, you pointed out that growth around the globe was even stronger than had been expected relative to the U.S., too. So could you expect to see global interest rates coming up, which is what we've seen with the German Bund, which is part of the reason the market has brought rates up here?
Yeah, Europe especially, I think, surprised to the upside. So if they have another good year, I'd expect upward pressure on rates from that. Are they going to have another good year? I don't know any better than anyone else. But again, I think if the long end is moving up in tandem with better growth prospects worldwide, then the bond market's doing our work for us. That doesn't mean that the Fed has to move to a restrictive stance.
Okay, so you just said basically all of us need to recalibrate what we think is high and low in terms of interest rates
Yes.
And it's not the absolute level. It could be the relative level from where they were.
Absolutely.
And people have warned us. I think Dalio and others have warned that a lot of people have borrowed a lot of money, and they're paying a certain level of debt service right now, and even if it's only back to what seems historically low levels, they still got to pay a lot more than they're paying now.
Including the government.
Yeah, including the government. So
yeah.
Okay, let me ask you this. So we recently had I would approach this in a couple ways. Number one, the stock market's up 40% since the election. So I used to think a lot of the stock market was you guys, was staying at zero, extraordinary measures, the big balance sheet, animal spirits you guys tried to engender, asset value, they go up as you stay at zero, and maybe it wasn't fundamentally based. Is there any truth to that? And do you think that you handed off the stock market baton to the real economy in the last year?
Yeah, I would say this. 2017 was not the Fed. Definitely not.
Was it? Then you're admitting before that it was the Fed?
It was a better argument a couple years ago when I was here. But last year, it was really the global growth surprise. And as I was just saying, it was bigger outside the U.S., that growth surprise, than it was inside the U.S. But everyone was up. It was up simultaneously. China was up. Japan was up. Europe was up. So, and naturally on equities, of course, 50% of the profits are coming from overseas. So that was a big driver for the market. Plus the deregulatory agenda, the growth agenda, all good, I think, and all help drive equities. Also, just kind of a banner year. You didn't have anything going really wrong during 2017.
Can I just parse what you said a moment ago? You said the idea that we have to go 100 basis points in 2018, you think the market is maybe getting ahead of itself because that would be price for perfection for that to happen.
Yeah.
I think yesterday's action, granted this was just knee-jerk reaction, quick reaction to the FOMC, but I think if you look at yesterday's market action, traders looked at this and thought, great, things are going well, there's a lot of growth, and then they thought, oh my gosh, things are going well, and that means the Fed's going to raise rates even faster than we anticipated. What you just said by saying, 100 basis points in 2018 may be overly aggressive, makes me think that they jumped to the wrong conclusion yesterday afternoon.
I think there'll be a lot of continuity in policy. I think we've got to give Jay a chance to settle into the job.
Jay Powell.
Jay Powell, and I think he'll do a great job, but this is continuity. It's all about continuity. Very similar to the Yellen policy, very deliberate, very data dependent. And, the idea that we're going to go in lockstep without paying attention to the economy, that's too much. I think it's going to be data dependent. And a lot of things would have to go right through 2018 to get the full 100 basis points coming in.
So for stock market investors, I mean, it was amazing for the last year, obviously, when you get a 40% move in stock prices. So a 10% correction was welcomed by a lot of people and not surprising. But we all look for reasons, or we all look for something underneath the surface that could turn 10 into 20 or 25 or whatever. So everybody said there's no housing bubble, there's no, we don't have these crazy instruments that are totally leveraged, there's nothing like that. So I always come back to a Fed policy mistake as the thing that people in the back of their minds are still worried about. And the balance sheet is so big, you still haven't extricated yourself from staying at zero for so long. Is there a potential for a policy mistake by the Fed right now? And would it be either way? Would it be tightening too fast or staying low too long? Could you screw up on either side of that? Or what's more likely?
What I'm mostly concerned about is
screwing up by being too fast.
Kind of plow ahead and raise rates based on.
Well, that's the new Bullard. Yeah.
Based on a conception of, sort of the 80s and 90s, which isn't the world that we're living in today. I think we're just living in a lower level of interest rates today, and we don't have to do as much just to get to neutral.
But soft landings are hard to. Supposedly it's never been done where you get one. How do you know you're not behind the curve?
Core PC inflation is 1.5%.
Yeah, but that's what hit the market recently.
It's going to come up a little bit in March, April of this.
So it won't surprise.
But that's not a surprise now. So and we'll still be below 2% at that point. These Phillips curve effects are so weak. Even an unemployment gap of 100 basis points. That meaning, you think the natural rate of unemployment is 5%, we're at 4 or something like that. if you look at the estimates, that's only going to cause 7 basis points of inflation. That's how flat the Phillips curve is today. So the idea that you're going to all of a sudden, inflation is going to be upon us in this world where we haven't hit the inflation target for 5 years, I think that's a little much.
So you're absolutely convinced that so what do they call that kind of risk? So it's asymmetric.
I'm happy to pay attention to the data. And as data comes in during the year, we can make a judgment. But I wouldn't pencil in that we're going to do all these rate increases without.
But you think the risk is not in staying at low too long. The risk is in changing and going and tightening.
Yeah.
Too quickly.
The other aspect is that we are shrinking the size of our balance sheet, and that's been very gradual so far. But that'll start to kick in during 2018.
Yeah.
So you've got that going on in the background, and so maybe you don't.
But just letting stuff roll off. Though,
right.
Yeah.
But maybe you don't have to do as much on rates since you've got that aspect of the policy tightening already going on.
Interesting.
So for the year, you would put GDP in a range of what? And for 2019, what would your range be?
Yeah, 2.4, 2.5 for the year over
2018.
Yeah, for 2018, and then slower after that in 2019. I hope it's better. I hope the growth agenda works, but my idea about that is that we can wait and see. We don't have to get out in front of that. We can wait and see if that's what happens. And if it does, and rates naturally are moving higher, then I think we should.
What have we been averaging in the past 8 years? 1.5 to 2? It's 2 to 2.5 for 2000.
2.1% since.
So then we're back to that in 2019.
Well, the potential growth is low for the U.S. Most people think labor force is not growing very fast, and productivity has been low. So what you really need here is you need the investment boom, and that's got to feed into productivity. That's what you need.
So that's possible.
Let's look. Oh, yeah, absolutely.
Then you'd have to raise 2019.
But you don't have to get in front of that. You don't have to be preemptive.
As the Fed, you have to react to things?
I think you should in this environment. Look, in other environments, I've been a leader in trying to be preemptive, but I wouldn't try to be preemptive here.
Well, God, I could be on that. I can do that. You don't need to anticipate anything at the Fed. You just look at what happened and how much does it pay?
In this environment, I think that's the best way to go, and that's served us well in the last 2 years here.